Welcome to this week's segment of Strategic Wealth University. I'm Jordan, and today I want to talk with you guys about a couple of really interesting things. Two different strategies on how we can maybe find a way to mix and match our portfolios. Now, in today's economy, some people want some of their money to be safe, and then some people want part of their portfolio to be at risk. So really, we want to figure out different ways to where we can mix and match. Now, there's two different ways I want to share with you today. The first way is using the rule of 100, right? The rule of 100. Now, I know we talk about this some on the TV show, but I want to kind of recap it and go over it again today because sometimes it can get a little tricky. Basically, the way it works is we take our age, and that's the percentage of the portfolio that should be in investments that are 100% safe and protected. Now, when I say safe, what I mean by that is if the market falls by 40% or 30% or 20%, we don't lose a penny. We're 100% safe and protected. In years like that, our clients like to say that zero is a hero. Now, the remaining balance, the number 100 minus your age, that's the part of the portfolio where if we want to, we can take some risk. Now, again, if you're real conservative, you don't have to take risk, but maybe someone for a conservative, moderate to moderate person with their risk tolerance, this could be a great rule of thumb to follow. So as an example, let's say someone is 60 years old. Well, that means that about 60% of their portfolio could be in investments that are 100% safe and protected. Now, the number 100 minus 60, the remaining 40%, that's the part of the portfolio where if we want to, we can take some risk. Again, we don't have to, but if we want to, we can take some risk. So, if you're 60, it's a 60-40 split. If you're 70, it's a 70-30 split. If you're 50, it's a 50-50 split. And again, I don't think I would stress if you go further out than maybe 5 to 10 percentage points from this rule. I certainly don't think that I would stray any further than that, especially with all the volatility that we experience in the economy. We want to pay really close attention to our risk and our safe investments. And really a couple of different strategies. I had someone ask me the other day, they said, Jordan, you're talking about the rule of 100. What are a couple of different strategies we can use? What are some examples of safe money and risk money? But with the safe money, I want to find some growth. I want to have the opportunity to get some growth with it. I said, that's a great question. Really, when it comes to the rule of 100, there's a few different safe investments that we could use, and I'm just going to use a couple. First and foremost is cash. Cash doesn't have a whole lot of growth with it right now with our interest rates, so it can be appropriate for a small part of someone's portfolio, but it's not really going to give us a good rate of return. Now, a couple of different strategies that are safe money could be maybe a CD. And again, CDs don't have a ton of growth right now, especially with interest rates being so low. So a couple of other strategies we could use. One is a fixed annuity. And with a fixed annuity, that's just going to pretty much give us a fixed rate of return, maybe somewhere between 2 to 3%, possibly 4%, but there's not a whole lot that's going to be more than that. So somewhere between maybe 2 to 3%. Then another strategy could be an index annuity. And the way that works basically is whenever the market grows, we get to grow with it up to a point. And whenever the market falls in value, we're 100% safe and protected. So those could be some potential safe investments. Now, when it comes to at-risk investments, there's quite a few different options. One would be a stock. A lot of times people worry about stocks because they want some risk, but maybe not as much risk as an individual stock. So what oftentimes comes into the equation are maybe mutual funds or variable annuities. With those types of strategies, when the market grows, we get to grow with it. When the market falls, we fall with it. We're a little bit more diversified. The challenge, though, with some of those accounts, not all of them, but some of those mutual fund accounts or variable annuity accounts, we quite possibly could be paying high fees. And a lot of people, especially with the changes that we're seeing in regulations right now in financial services, fees are starting to come down. And a lot of folks are paying closer attention to their fees. So we want to lower those as much as possible. So another strategy that oftentimes pops up is what's known as an exchange-traded fund, right? An exchange-traded fund. And that basically takes the best of both worlds of stocks and mutual funds. And that's another risk-based investment. And again, just with any of those investments, you can get one that tracks anything from the S&P 500 to the Dow to the price of 3D printing, but anything really that's in the stock market or quite possibly in maybe the commodity market or the real estate market. So that would really be the difference between our safe investments versus our risk investments. And oftentimes you can plug those in for the rule of 100. Now, the second type of strategy we could use is really just reverse engineering for income or making sure that we have enough money in a liquid bucket or in a safe bucket. A lot of times people will come into the office and they'll say, Jordan, I have $1 million and I need 500,000 of that to be 100% safe. I'll never worry about losing anything. And then I'm comfortable with the rest being at risk. And if that's the case, it can sometimes be a little bit of a simpler strategy, but I think that using those two strategies, or maybe possibly one or the other, could be helpful for a lot of individuals, and that could possibly give you a better idea or a roadmap as to what makes sense for you. Now, as always, if you have any questions, check us out on the website. Feel free to give us a call. Thanks for tuning in this week, and we look forward to seeing everyone back here next week. Thank you.